Good morning. Please come to this wonderful chapter in Index 32 Financial Instrument Presentation. So, first we will see today the meaning of financial liability. In this chapter, first thing I need to now learn what is financial liability, because the main purpose of the standard is to help you to identify the item on the liability side, whether it will come under financial liability or equity. So financial liability is a liability. So first of all, it should meet the definition of a liability. A liability is a present obligation arising out of past event. Settlement will result into outflow of resources. Reliable estimate can be made. Okay, arising out of past obligating event, and you can measure it, then it is a liability, and it should meet any of the following four conditions. Any, underline the word any. If it meets any of the following four conditions, then we will call it as a financial liability. So a liability will become financial liability if it meets any of the four conditions. First condition, we will call it element number 1. Element number 1 means financial liability is a liability that has a contractual obligation. So important term is contractual obligation. Income tax liability is also a liability, but it is not contractual obligation, it is statutory obligation. So it has to be contractual obligation arising under some contract between two parties. And what is that contractual obligation? Contractual obligation is to deliver cash or any other financial asset. The contractual obligation is to deliver either cash or any other financial asset. Example of any other financial asset is bank or bills receivable or investment. Now if you look at this example, trade payable, this will come into the definition of element number 1 because there is a contractual obligation to pay cash. Debenture, 9% debenture issued by the company, there is a contractual obligation to pay cash, interest, principal. Or even redeemable preference share, 9% redeemable preference share will fit into this definition now. So because of the standard now, what will happen? The preference shares will also get classified as liability. Earlier, under old GAAP, preference share is still shown in share capital, but under this standard, because there is a contractual obligation to pay cash or any other financial asset, even this redeemable preference share will be classified as a financial liability. So any liability which is contractual obligation, the contractual obligation is to deliver either cash or any other financial asset, is a financial liability. Now you tell me, provision for warranty, is it a financial liability? Apply the above definition. Provision for warranty, not a financial liability because there is a contractual obligation, but the contractual obligation is not to deliver cash or other financial asset. In a warranty, you promise the buyer, the customer, that we are going to repair the goods, rectify the goods. So it is not a financial liability. What about deferred tax liability? Will deferred tax liability be called financial liability? The answer is no. There is no contractual obligation to deliver cash. Okay, your stipend payable to article clerk, stipend payable to intern, is it a financial liability? Yes, because there is a contractual obligation to pay cash. So that will be called as a financial liability. it means that contractual obligation cannot be avoided. Example of liability which will come under the first element: loan payable, debenture, trade payable, expenses payable, bill payable. So if these all are payable in cash or another financial asset, they will be called as financial liability, and in the balance sheet you will present under the head financial liability. What about deferred revenue? Deferred revenue means advance received from the customer. Will it be a financial liability? No, because the objective or the contractual obligation is to deliver goods. Advance received from customer, there is a contractual obligation to deliver goods. Warranty obligation, there is a contractual obligation but not to pay cash or other financial asset, but to provide rectification, repair, damage of goods will be rectified. So that is your promise to the customer, not the promise to pay the cash. Hence, such item which may be contractual obligation, but since they involve delivery of goods and service, not delivery of cash or financial asset, they are not financial liability. They are liability, but they are not financial liability. So therefore, they will be outside the scope of this standard. So please come to question number 1. At the end of the chapter, you have question number 1. I have taken some of the most important question. We will discuss the concept and we will discuss 1 or 2 examples on the concept. So the question number 1 says, A Limited makes purchase of steel for its consumption in the normal course of business. Entry: purchase account debit to trade payable. Purchase account debit to trade payable. A Limited makes purchase of steel. The purchase terms provide for payment of goods at 30 days credit and interest payable at 12% per annum for any day beyond the credit period. Analyze the nature of this financial instrument. So the question is whether this trade payable is a financial instrument. Whether the trade payable in this above example is a financial instrument, and what kind of financial instrument. So it is a financial instrument because it is a financial liability for one party and financial asset for the other party. And why it is a financial liability? Because there is a contractual obligation to pay cash in 30 days plus any interest if it is delayed. So the answer is yes. A Limited has entered into contractual arrangement for purchase of goods for a fixed consideration payable to the creditor. A contractual arrangement that provides for payment on fixed amount of cash to another entity meets the definition of financial liability. So revise, first element was contractual obligation to deliver cash or another financial asset. Element number 2, a financial liability which has a contractual obligation to exchange financial asset or to exchange financial liabilities in potentially unfavorable condition. Underline, in potentially unfavorable condition. It means that you have a contractual obligation. Under that contractual obligation, you will exchange financial asset or financial liability, but the contract is unfavorable to you. Contract is unfavorable to you. So according to the definition of financial liability, even these type of contracts will be called as financial liability. Okay, suppose this is Mr. A, Mr. B. So Mr. A and Mr. B enter into a contract that A will deliver 1 share of ITC at 250 rupees. So this is like a forward or a future contract. Okay, forward or future contract after 2 months. So this is a forward or a future contract. Now what happens on the reporting date, on the balance sheet date, ITC price is 500 rupees. ITC price is 500 rupees now. So what is the promise of A to B? I will deliver to you one share of ITC at 250 rupees, but the price on the balance sheet it is 500 rupees. So A will deliver one share and A will receive 250 rupees, but the share which is going to deliver is worth 500 rupees now. So contract has turned unfavorable for A. Contract has turned unfavorable for A, and therefore for A it will become a financial liability. For A it will become a financial liability. So the category of liability which will fall under element number 2 would be derivatives, because in derivatives the contract becomes unfavorable to you due to price movement. So such derivative contracts which will become unfavorable to you due to price movement, those derivatives will become financial liability and you will have to account for it. So you'll have to bring the derivative liability in the books if they become unfavorable to you. So because of this standard now, companies cannot just enter into derivatives and avoid the accounting in the books. If the derivatives turn out to be unfavorable, they will have to show it as a liability and the other party will show it as a financial asset, both. It should be financial liability for one party and financial asset for the other party. These are derivative liability where we may be positioned in unfavorable condition in future and will be required to pay in cash or bank or investment or any other equity. So example of element number 2 would be derivative liabilities which have become unfavorable, derivative contracts which have become unfavorable. And if derivative contract are favorable, then they will be called financial asset. So what is the example? Derivative contracts which have become unfavorable. I'll give you 2 more examples. One example is X Limited, a writer. Writer takes a short position in a call option with a holder at an exercise price of 50 rupees. So Mr. A, Mr. B, suppose A is call writer, B is call buyer. So Mr. A has entered into a contract with Mr. B. What is the contract? Contract is that A will deliver rupees 1 share at rupees 50. B has a right to buy and A has an obligation to sell. That is called call option. You are under an obligation to deliver at rupees 50. B is having a right to buy the share at rupees 50. Contract can be settled on a net basis. Net basis means without physical delivery of share. Now on the balance sheet, the market price is 60 rupees. Oh my God. But what A has promised? A has promised to deliver at 50 rupees. The market price is 60. So contract has become unfavorable. How contract has become unfavorable? A will have to deliver 1 share at rupees 50, whose market value is 60, and what it will get in return? A fixed amount of 50. So 10 rupees loss. If he is a call writer, he will have to suffer a loss of 10 rupees. He will have to pay 10 rupees differential to Mr. B. So contract has turned unfavorable to Mr. A. So for Mr. A, it will become a financial liability. and for B, it will become a financial asset. One more example we'll take. Suppose there are two parties, A and B. A is a put writer. A is a put writer. Put writer has an obligation to buy. Put writer has an obligation to buy, and B is a put option holder. The put option holder has a right to sell. Only this basic thing you should know, which they normally teach you in SFM. A put option holder has a right to sell. So what is the contract? The contract is that B has a right to sell to A one share at rupees 50. Look at from A's point of view. A has an obligation to buy at 50 rupees. Come what may, it has an obligation to buy at 50 rupees. Now the market price is 40. The price of the share has gone down. So for whom the contract is unfavorable? The contract has become unfavorable to Mr. A because he is still under an obligation to buy at 50. So he will pay 50. He will pay 50. He will receive an asset of worth 40 only. So you pay more 50, you receive less 40. So for Mr. A in our example, the contract has become a financial liability. It is called derivative financial liability. So this is element number 2. So we'll take a question on this. Question number 2 in our book. At the end, PQR Limited issues a call option. PQR issues a call option to ABC Limited. So PQR is a call writer to buy the share at rupees 100 per share. The call option is settled on net basis. But if on the balance sheet date the market value of the equity share of PQR is 110, same example, then you have a obligation to settle 10 rupees. Call option means obligation to sell at 100, but the market price has become 110. So you will sell at 100, you will receive 100, but the market value of the same item is now 110. So the call writer has to pay the differential 10 rupees to the call buyer. That is how call option works. If the market price exceeds the exercise price, the writer has to pay the difference. So examine the nature of the instrument. So in the exam, how do you know what is the nature of the instrument? There is a contractual obligation to deliver cash or financial asset under potentially unfavorable circumstance now. So element number 2, that definition is satisfied. Okay, element number 2 says contractual obligation to exchange financial asset or financial liability under potentially unfavorable condition. So for PQR, the contract has become unfavorable and therefore there is a liability of 10 rupees which we will call derivative financial liability. So let us revise one more time. What was the element number 1? Element number 1 was contractual obligation to deliver cash or any other financial asset. And the second one is contractual obligation to exchange financial asset or financial liability under unfavorable condition. Then third element is, the definition has 4 elements. If any condition is satisfied, it is a financial liability. Element number 3 is financial liability is a liability which has a contractual obligation. One thing is common, which is contractual obligation, which is a non-derivative in nature, and will be settled in our own equity instrument, which will be variable in nature. So contract which will be settled by own equity share in variable numbers. Simple example, suppose I have to pay you 10 lakh rupees. So I have a contractual obligation to pay rupees 10 lakh. So this is basically a loan contract, you can say, which is a non-derivative contract. I have taken loan of 10 lakh rupees from you. Only example, after the class, don't ask me. Okay. And then I said I will settle by issuing shares of our company. How many share I will issue? That will depend on market price. That will depend on market price when I will settle it. Now see what will happen. I will deliver to you number of share which is based on market price when I will settle it. Market price is 500 rupees. How many share will be issued? 10 lakh divided by 500. 2000. But market price is suppose 1000 rupees. Then I will issue you 1000 share. Market price is 200 rupees only. I will issue 5000 share. So number of shares to be issued are varying. But you are not bothered. You are happy. You are happy. Why you are happy? Because you will get shares worth rupees 10 lakh on that date. So counterpart is not exposed to the risk. The counterpart is not exposed to the risk. He cannot be an equity holder. He cannot be a equity holder. He is a creditor for us. He is a creditor liability for us. We are using our equity share just like a currency. We are using our equity share just like a currency to settle the dues. Counterpart is not exposed to the risk. Therefore, such contracts are also called financial liability. A loan taken rupees 10 lakh, which will be settled by delivery of our company's share, and the number of share will be based on the market value on settlement date. And let us look at one question in the study material. Question number 3 on this point. Target Limited took a borrowing from Z Limited for rupees 10 lakh. Z Limited enters into an arrangement with Target Limited for settlement of loan against issue of a certain number of equity share of Target Limited, which values equal to 10 lakh. Same example has come in the book also. For this purpose, fair value of the share shall be determined based on the market price at a future date upon settlement of the contract. Evaluate this under the definition of financial liability. Now you are sitting in the exam hall. You have to quickly think, first of all, whether it is a financial liability or financial asset. So from the point of view of Target Limited, it is a financial liability. So Target Limited will call it financial liability. Then why it will call financial liability? Element number 3 is satisfied. Element number 3 is satisfied. And what is that element number 3? Contractual obligation, non-derivative contract, settled in own equity share, variable number of share. 4 points are there. Variable number of own shares. Variable number of own shares. So therefore it will become financial liability. And what about Z Limited? For Z Limited, it is a financial asset. We will see the definition of financial asset: contractual right to receive cash or another financial asset. Contractual right to receive cash or another financial asset. So therefore, equity share issued by Target Limited becomes a financial asset for Z Limited. Because to be a financial instrument, it has to be financial liability for one party, and at the same time it has to be financial asset for the other party. Therefore, Target Limited will show it as a financial liability. Z Limited will show it as a financial asset. Here the equity shares are being used as a currency for the purpose of settlement of amount payable by Target Limited. Therefore, because it's a non-derivative contract, variable number of share will be issued. Therefore, it amounts to financial liability. Okay. So, contractual obligation, non-derivative contract, settled in own equity share, and the number of share to be issued are variable in nature. You have to remember all this and understand and then remember. Make your own notes if you want to remember in a certain way. And what is element number 4? It is a little more advanced version of the previous one now. Whenever any contract which is derivative in nature, you will say element number 2 was also derivative. But in element number 2, it was a derivative to buy or sell any other asset or liability. But here it is own equity. Here it is own equity. So, difference between element number 2 and element number 4 is, in element number 2, suppose I enter into Ford contract to buy ITC share, Reliance share, then also it will come under element number 2. But in element number 4, it has to be my share, ASF Limited share. Okay. So, let us read further. Whenever any contract which is derivative in nature, so it has to be a derivative contract. Element number 4 is applicable for derivative contract. Then your question will be, what is derivative contract? It is defined in the paragraph number 10 below. Paragraph 10, if you see below, derivative contract has following 3 features. Derivative contracts have following 3 features. Value changes. As it's written in para 10, don't write. Value changes due to change in the value of underlying. Secondly, it is involving nil investment or low investment. And third is settled at a future date. Settled at a, so if a contract is a derivative contract, then come to element number 4. That means its value will change as the value of that underlying instrument will change. That is the definition of derivative. A derivative derives its value from underlying. And as the value of an underlying asset changes, the value of derivative also changes. Initially, it doesn't require any investment. Like in forward contract, just 2 parties enter into contract, no money is exchanged, or very low investment. Like in future contract, you have to pay initial margin money, or in an option contract where you have to pay a premium. So premium on a share of 2000 rupees, maybe 25 rupees, 100 rupees, 200 rupees, depending upon so many factors. So much lower than what you actually pay for that underlying, and they will be settled at a future date. So coming back to the definition of element number 4, the contract should be derivative in nature to be settled in own equity instrument. If it is settled in own equity instrument, check element number 4. If it is settled in any other asset or liability, check element number 2, it should become unfavorable. Should be recorded as a financial liability which will be settled in own equity instrument, except in case of derivative which will be exchanged for fixed cash against fixed number of own equity instrument. This exception will make derivative as a financial, as an equity instrument. So in short, what I will do, I will ask you to keep this in mind. Suppose there is a derivative contract. It will involve fixed amount of cash and fixed number of own share. Then it is equity. Fixed amount of cash and variable number of share variable, it is financial liability. Then variable number of cash, fixed number of share, financial liability. Variable amount of cash, variable amount of share, please don't mind the spelling, financial liability. In these three cases, the other party is also exposed to the risk. The counterparty is also exposed to the risk. So when you are transferring risk to the counterparty, he is like a, in this case, the counterparty is not exposed to the risk. My mistake. In this case, he is exposed to the risk. First case, why he is exposed to the risk here? Imagine, I say I will give you 100 share against 10,000 rupees payable to you. I will issue you my company's 100 share for a certain derivative. The price of the share goes up, you will enjoy. The price of the share falls, you will suffer the loss. So when it is fixed to fixed, the counterparty is exposed to the risk. Yes or no? If I give you a fixed number of share against a fixed amount, are you not exposed to the risk? Because my share price can fluctuate. My share price can fluctuate. I have to suppose pay you 10,000 and I say I will give you 100 shares only after 3 months. After 3 months the price can be 5 rupees only. 100 into 5, you will suffer the loss. So therefore fixed for fixed test means this exposes the counterparty, the other party to the contract, to a degree of risk which is usually borne by the equity owners. So that will be equity. But if any element is variable, either the cash amount is variable or the number of share to be issued is variable, then it will become a derivative financial liability. Keep this in mind. A derivative contract where fixed number of share will be issued against a fixed amount of cash is an equity instrument. Other than that means either cash is variable or number of share is variable or both are variable, it will be a financial liability. Okay. Like for example, you may say, we will issue you the share after 3 months. Contract is, will issue your share after 3 months equal to value of 100 grams of gold. Equal to value of 100 grams of gold. Now see what happens after 3 months. Value of gold 100 grams is 5 lakh. Share price is suppose 500. So the number of share to be issued is how much? 1000. Value of the gold is 5,50,000 and the price of the share is 100 rupees. The number of share to be issued will become 5500. So there both are variable. The amount to be paid is also varying and the number of share to be issued are also varying. Okay. So then it will become a financial liability. So even if one of them is varying, it will become a financial liability. Example, a written option to buy gold. Option to buy gold. If exercise is settled net in the entity's own instrument by the entity delivering as many as of those instruments as are equal to the value of the option contract. So here the number of share to be issued will vary. Number of share to be issued will, in fact the amount will also vary in this example because it is linked to the price of the gold. It is linked to the price of the gold. So as the gold price will vary, you will calculate the gain or loss. That gain or loss will be settled by issuing own equity instrument. The example that I have taken just now. So the number of share to be issued will vary The amount to be paid will also vary because the gold prices can change. So such contracts will become, come on, derivative contract. And on this, the institute has asked one question number 4 in your book, January 2021 exam, and there is a exactly same or similar problem in study material. So don't worry. Mark important question, again they will repeat for 4 marks. Jewel Limited. So first important question I have given today is question number 4 for examination sake. Jewel Limited entered into a transaction to purchase 1000 grams of platinum on 15 January 2020. The transaction provides for a price payable which is equal to market value of 1000 grams of platinum on 15th April 2020 and shall be settled by issue of such number of equity share as is required to settle the aforesaid transaction at a price of 100 rupees per share on 15th of April 2020. Whether this is to be classified as a liability or equity as per Ind AS 109. Is it a derivative contract? First check, is it a derivative contract? It's a contract whose value will change as the value of the underlying instrument will change. So the value of this contract will keep changing as the price of the platinum keeps changing. Okay, your contract is to pay a price equal to 1000 grams of platinum after 3 months. So as the underlying value will change, the value of contract will change because you will have to pay more or less. No initial investment was required. No initial investment. And third is settled at a future date. Settled at a future date. Settled at a future date. After that, we have to see it will be settled in which form? It will be settled in the form of own share. It will be settled in own share. So we are in element number 4 now. It's a derivative contract which will be settled in own share. Now the next question is whether number of own share to be issued is fixed or variable. So the answer is number of own share to be issued is variable. How it is variable? You will calculate the value of 1000 grams of platinum, which will vary. So suppose 1000 gram of platinum is, I don't know how much is platinum, 30,000. My God, if in 30,000 you get 1000 grams of gold, please tell me where it is available. I will not come in the morning every day. Is it right? It's so painful to get up at 4:35, take a bath, then go and have tea without breakfast, come to class, teach for non-stop 3 hours. I will buy platinum only for 30,000. And you have to issue share at 100 rupees. So as per your calculation, 300 shares will be issued. But suppose the platinum price is 50 lakh rupees for 1000 gram, then you will have to issue 50,000 shares. The number of share can vary from 300 to 50,000. Okay, so it fulfills the definition of financial liability element number 4. A derivative contract settled in own equity share other than fixed for fixed, other than fixed cash and fixed number of share, right? So you are required to explain with reason. For 4 marks, How do you check, write the answer in the exam? This is an actual exam question. First check whether the contract will be settled in own share, yes. Whether it is derivative or a non-derivative contract. So if I apply the definition of derivative, it meets the three requirement: nil investment, future date settlement, value changes. Then you apply fixed for fixed test. So we are going to settle in own share and it is a derivative. Now whether we are going to pay fixed number of share against a fixed amount, the answer is no. Okay, the answer is no. Why it is no? In the given case below, write last two lines. J Limited has entered into a contract which will be settled at a future date. It qualifies as a derivative and it will be settled in own share. Since the consideration arising on 1000 gram of platinum will provide a variable amount of cash against number of share which will be decided in future, it is classified as a financial liability. So the number of share will vary as the value of that 1000 gram of platinum would vary. So therefore it will be treated as a derivative financial liability. Initially it will be recorded at fair value, subsequently also at fair value. Change in fair value will be recorded in profit and loss. Right? So I have made a small summary of the concept for both fixed test and fixed for fixed test. So what the student has to do, if it is a non-derivative contract, means it passes fixed test. Fixed test means fixed cash and fixed number of share. Fixed cash and fixed number of share. If both are fixed, then it is an equity instrument. Because fixed number of shares are issued, and you can just mention here, counterparty is exposed to risk. Counterparty, the holder of the instrument, is exposed to the risk. The holder of the instrument is exposed to the risk. Who is exposed to the risk? The equity owner is exposed to the risk in a entity because he takes the hit. What will happen in the first example? I have to pay 10 lakh rupees to you and I will issue you 100 shares of my company. So you are exposed to the owner risk. If the price of the share falls to 5 rupees, you will get only 500 rupees and you have given me 10 lakh rupees loan. But if the price of the share goes to 2000 rupees, you get 20 lakh rupees, something like that. Okay. So therefore, the counterparty is exposed to the risk of an owner. So if he is the owner, I have issued equity share to him. If you are the owner of my company, then you are an equity owner, then I have issued you equity instrument. Am I right? But if the fails fixed test, means the number of share issued are variable, it's a financial liability. Here our own currency is being used to settle the liability. So here what is the logic is, own shares are used as currency. Own shares are just used as currency. Instead of paying cash, you are just settling it in your own share, which is used like a currency. And another way to look at it, the counterparty is not exposed to the risk. He will get shares worth rupees 10 lakh only. You have given me 10 lakh, I will issue shares worth rupees 10 lakh. Derivative passes fixed for fixed test. Passes fixed for fixed test means fixed amount of cash against fixed number of shares. Fixed for fixed test means fixed amount of cash against fixed number of share. So such contracts will be called equity instrument, because then the counterparty is exposed to the risk. Okay. Issuer does not have an obligation to pay cash. Holder is exposed to the variability. Write down. Holder is exposed to the variability. Because if I pay a fixed number of share, the counterparty is exposed to the risk. Okay, then next is fixed cash, variable number of share. Fixed cash, variable number of share will be a financial liability. Own equity instrument are just used to settle a liability. So own equity instrument are used like a currency. Passes variable for fixed test. Variable cash, but the number of shares are fixed. Again, financial liability. Issuer does not have an obligation to pay cash. The holder is exposed to the variability and passes both variable for variable test. If any of the two tests, if you pass, it's a financial liability. If you pass both tests, you are bound to be a financial liability. Okay, both parties are exposed to the risk here. So in short, if you don't want to remember so much, only one thing: fixed for fixed equity, and if any of the two element is varying, either cash or equity share, then it is financial liability, whether it is a derivative contract or a non-derivative contract. Now here there is a clarification on financial liability. There is an exception. What do you mean by exception? Exception means it meets the definition of financial liability. If you apply the definition, it will meet, but it is treated as deemed equity. It is treated as deemed equity. So even though applying the definition clause, it might meet, financial liability, but they are called as deemed equity. So they are exception if any of the element is satisfied for financial liability, but such instrument qualifies conditions to be deemed equity. So now some instrument may have features of both. It has features of financial liability also, and it has some features of equity also. Okay, they are called deemed equity, which we will see in the last part when we will come to this para 16A, 16B, 16C, 16D. There we will see what instruments are deemed equity. Then what I will do? The standard says you treat them as deemed equity. The standard says you treat them as deemed equity. So they will come under equity in the balance sheet, under the head equity in the balance sheet. Then consider it as a deemed equity. I will take the meaning of deemed equity after some time in this paragraph 16A, B, C, D. Don't worry, we will take that. Next is, what about share warrants or similar rights? Share warrants or similar rights means you pay a fixed amount and you get a fixed number of share. Have you heard share warrants? Share warrants are financial instrument which can be converted into fixed number of share by paying a fixed amount of cash. So they satisfy fixed for fixed condition. Fixed cash is paid, fixed number of shares are issued. Because they pass fixed for fixed test, they will be classified as equity instrument in the balance sheet. If any contract has settlement alternative, now this is another important point. A contract has settlement alternative. I have issued you the debenture and I am telling you, you can either take cash or you can take shares from me. So I have a settlement alternative, but settlement alternative is with whom? Is with you. So I will call it as a financial liability. Because if you demand cash, I have no alternative but to pay you the cash. So I have an obligation to pay cash which cannot be unconditionally avoided. Is it right? I have given you two choices, cash, share. If you want cash, I cannot avoid it. I can't say, see, I have given you choice. You should use equity as a choice. Then what is the point of giving the choice? And if you demand cash, I cannot avoid it. So in that case, that amount is also a financial liability. So a very thumb rule is that, if you have a contractual obligation to pay cash, which cannot be avoided, it is financial liability. It is financial liability subject to exception given in para 16A, 16B, 16C, 16D of Ind AS 32 deemed equity. Other than that, contractual obligation to pay cash which cannot be avoided is a financial liability. So in the exam, that is a simple test you have to perform. For complicated issues like where there is a settlement obligation, meaning of derivative is a financial instrument or a contract. Derivative is a contract which satisfies all of the following condition. Underline the word all of the following condition, and in the exam you should quote this definition like we did in that problem of Jewel Limited, that as per Ind AS on financial instrument, derivative should have following three conditions satisfied. Its value changes as the value of the underlying changes. Underlying means anything whose value can change. Like for example, now you are very much familiar, interest rate. So we have in the market nowadays interest rate futures. As the interest rates fluctuate, the value of interest rate future, interest rate options would fluctuate. And index, very popular is Nifty index. Yes or no? Many of you do trading also in that. So as the Nifty index value changes, the value of that call or put or future on Nifty keeps changing. Then commodity prices. Gold future is traded. Oil futures are traded. Metal futures are traded. And as the value of gold, silver, metal, etc. changes, the value of that contract keeps changing. Then there are very popular forex is also underlying. The call option, put option on this euro, dollar is available now. Share, very popular, or any other benchmark. It can be, the underlying can be a financial or a non-financial asset. It can be a non-financial, like gold is a non-financial item, but there are derivatives on gold also. There are derivatives on weather also. There are derivatives on electricity also. In fact, you can create a derivative on anything whose value is likely to fluctuate either side. Either side. If it is only one side, then you won't get a counterparty. Is it right? Counterparty also thinks in a reverse manner. So first is there must be an underlying. The value of the derivative changes as the value of the underlying changes. Second thing, which you know, it requires zero investment or very small investment at inception. Like forward contract, you and your friend enter into a forward contract. If Sensex goes above 60,000 point, I will pay you 10,000 rupees. That's a forward contract. No investment was involved today. Or you can enter into a future contract on the exchange for the same thing. You can enter into a Nifty future contract that Nifty will be going above 20,000 point. But then exchange will not allow you to enter into such contract unless you pay margin money, that is initial margin money, and then you have to pay mark to market margin. Some investment is required, but that is much lower than the value of the underlying. Gold future, 1 kg gold you will buy for 50 lakh rupees, but future on 1 kg gold can be entered into for 5 lakh rupees also. So where you require 50 lakh, you can get the same benefit for 5 lakh rupees also. So very low investment, and that is why derivatives are very popular. Reliance call option is available for 45 rupees, 100 rupees, 150 rupees, whereas the one share of Reliance will cost you 2500 rupees. And the beauty of the derivative is that they are settled at a future date. Let some gap be there, only then the fluctuation will happen. If you buy it today, it is called spot market. Okay, you know what is the exact amount you are going to pay or receive. In a derivative, the settlement is at a future date, so there is a fluctuation possibility. What are the example of derivative? Call, put, future, forward, swap, interest rate swap, currency swap. All this you will study in detail in SFM. Now we'll come to the accounting part. Ready? Accounting begins now. When should financial liability be recognized? What is the point of time that yes, now I should bring financial liability in the books of account? So the answer is financial liability should be recognized when the entity becomes a party to it. What do you mean by party to it? It means when the contractual obligation can be enforced by the law. So when the entity becomes a party to it, that is the contractual obligation can be enforced by the law. Now our accounting begins now. Pay attention. For exam purpose, the first few paragraphs, one possible question is there. They will give you a case study and they will ask you to check whether it is a financial liability or equity. And I have given you 4 elements. 1, 2, 3, 4. You have to check whether any of the 4 elements are satisfied. If yes, financial liability. If not, it is not a financial liability. Then it can be either some other type of liability or equity. Okay. Now, once you are sure it is a financial liability, then what is the next task you have to do on the inception date? On the inception date means when you will bring it in your books, when you will recognize it, on that date only, you have to, suppose a child is born, on that date only you have to give a name. What name? Only 2 names are allowed. A financial liability has only 2 possible names, FVTPL or amortized cost. Okay, but again there is no choice here, there are conditions. Subject to those conditions, you will call them amortized cost or FVTPL. What is the full form of FVTPL? Fair value through profit and loss, which means they will be measured at fair value on inception date, reporting date, settlement date, and every time the fair value will change, they will be routed through profit and loss account. Concept of prudence goes for a toss. What did I say? Concept of prudence goes for a toss here. If the fair value results into gain, you will recognize or record the gain also in the profit and loss account. But this is how the standard has been drafted. World over, now the focus has been shifted from P&L account to balance sheet. Balance sheet must give you true and fair view. So if you want balance sheet to give you true and fair view, on the balance sheet date, whatever is the fair value of your assets and liability, that must be reflected. Otherwise the balance sheet is of no use for understanding the net worth of a company. If it is based on some other figure and today the market value is different, an investor cannot evaluate what is the worth of this company. So with that objective, focus has shifted to balance sheet. Balance sheet should be right. Balancing figure is P&L account. P&L account is like a balancing thing. Okay. To make the balance sheet proper, if require, difference goes through P&L account or OCI or SOCIE. Balance sheet has to be perfect. That is the theme now. Earlier the theme was P&L account should be right. We should not show the profit which is not realized, which is a future profit. Those concepts have taken a back seat now. Okay. So because this query comes every time, that are we not recognizing the unrealized gain in the P&L account? You are right, but this is the thinking. So first we will see, when will a financial liability be FVTPL? So financial liability will be FVTPL in following 4 cases. So if it fits into one of these 4 cases, then it is FVTPL, and if it doesn't fit into these 4 cases, by default it will go to amortized cost. First is derivatives. Derivatives are always FVTPL, always. Okay, because first of all their maturity is very short and the value keeps fluctuating a lot. The value keeps fluctuating a lot. So in order to have a fair presentation, it is better derivatives appear at fair value. Then similarly, if you have given financial guarantees, loan guarantees, now as per the standard on financial instrument, these are also shown at fair value. These are also shown at fair value. I will take a question on this and this in our next chapter, Ind AS 109. We have a question on that, not in this. Here the focus is not accounting. In this chapter the focus is presentation, whether it is a financial liability or equity. Of course we'll do some accounting also. Then contingent consideration. Remember Ind AS 103, already covered in Ind AS 103. A contingent consideration payable in cash or a contingent consideration payable in variable number of equity share are to be fair valued as per Ind AS 103. Yes or no? So therefore, if it is a contingent consideration in a business combination payable either in cash or variable number of own equity instrument, it will be fair valued on every reporting date and the change is transferred to P&L account. Now you'll see how the different standards are connected. And the next is accounting mismatch. Management. Now here it is little discretionary. Discretion is given to the management. Discretion to management that you can classify a financial liability into FVTPL if it helps you to remove accounting mismatch. It helps you to remove accounting mismatch. So this I will tell you later, because to understand that point I need to explain many other points also. So this is pending from my side. These 2 questions will be covered in 109. Here we have already covered questions, 3-4 questions we have covered on contingent consideration in Ind AS 103, and this we will discuss at a future date in this chapter only. So if it is not one of these 4, okay, then by default it will be called as financial liability at amortized cost. So in this exam you have to check whether it is a derivative, financial guarantee or loan contract, loan guarantee, contingent consideration or accounting mismatch. If one of the 4 situation exists, FVTPL, otherwise amortized cost. Just to clarify something, some student may have already studied this chapter before, so he must be wondering there was something called FVT OCI also. Where is FVT OCI? Financial liability does not have a category called FVT OCI. Financial asset has a category called FVT OCI. So financial asset has 3 categories: FVTPL, FVT OCI and amortized cost. So sometimes there is a confusion. This category is not there for liabilities. For liabilities we don't require. We require it for asset because we hold asset with some vision. Don't hold liabilities with a vision. Yes or no? I invest in a company either to make trading profit out of it, or I want to hold it as a strategic investment for a long term. And I'm not interested in day to day fluctuation. So that is why they have created a category where you have invested with a long term vision in a strategic stake in a company. So that those instruments are FVTOCI. I don't incur a liability for such a strategic vision. Okay. So they must have given a lot of thought behind it. And they said let the liability side have only two classification. So how do you measure the financial liability at amortized cost? So we have to learn first on inception what is the amount you will put in the books of account. On inception date, basic theme is financial liability should be measured at fair value. Throughout the standard, whether it is FA or FL, FA means financial asset, FL financial, whether it is FA or FL, initial recognition is at fair value. But then usually the amount you receive or pay is the fair value. Am I right? I said, give me 10 lakh rupees. So it's a liability for me. Should I sit down and spend my time and energy in checking what is the fair value? If the deal is at the market rate, it is fair value. Of course, if you say, sir, I will give you a 10-year loan and I will not charge you interest, then that 10 lakh is not fair value. Then I have to calculate the fair value. It's usually we assume that the amount you receive is the fair value if the transaction is at a market rate. If the transaction is at a market rate, okay, otherwise not. We will see later, if it is not at a market rate, that means it has some other component involved also. It has got some other element involved also. So that element needs to be removed, and what is that element? Accordingly, the accounting for that element will be done. So how do we compute the fair value? It is usually proceed minus transaction cost. Proceed minus transaction cost. Like debenture issued 1 lakh minus issue expenses, flotation expenses 2000, 98,000. So we will pass an entry bank account debit 98,000 to financial liability 98,000. That's it. Okay. If it is short term in nature, then it is not discounted. Short term means less than 12 months maturity. No need to discount it because it is going to be settled within 12 months. Any difference on settlement will be transferred to profit and loss account on settlement. Suppose it is a short term instrument, I have to pay 1,10,000 rupees on settlement. So on the settlement date, if it is short term, financial liability 98,000, P&L account 12,000, to bank account 1,10,000. That is how we have agreed. You give me 1 lakh rupees loan, I will pay you after 12 months, on 12 months, 1,10,000. I paid, but my book value is 98. So automatically this finance cost will go to P&L account. So simple. If it is long term in nature, then it is discounted. Then it is discounted. Usually we will assume that proceed less transaction cost is the fair value of a liability. Usually what we assume? Fair value is equal to proceed less transaction cost. But then how do we do the subsequent accounting? The subsequent accounting will be done by computing what is called effective interest rate, EIR. Effective interest rate, or in your language IRR, internal rate of return, same thing. Okay. So subsequent accounting will be done by using effective interest rate method. So I will summarize for you. Fair value is equal to proceed minus transaction cost, assuming transactions are at normal terms. Okay. And second, effective interest rate means IRR, that rate of discount at which fair value is equal to the present value of the contractual obligation. So it is what we call in financial management language IRR. So you have fair value today, you have future cash flows, contractual obligation. Find out a discount rate whose present value is equal to this amount, and that discount rate is called effective interest rate, which means you have to know how to compute the EIR. What about exam? Do they give EIR? No. No guarantee. No means not sure. They may give you. If they give you, take it and solve. Don't sit down and start checking. But if they don't give you, then one should know how to compute the EIR. Now, because it is financial liability at amortized cost, it is not subsequently remeasured at fair value. That is why it is amortized cost. It is cost subject to some adjustment for interest, etc. That's it. Change in fair value will not affect accounting for amortized cost instrument. Okay. Change in fair value institute may give you, but you have to be firm. If it is amortized cost liability, I will not change the carrying amount. I will take the initial inception account, bank to financial liability. Then if it is a long-term instrument, I will calculate borrowing cost or finance cost by multiplying the opening balance into effective interest rate. By multiplying the opening balance into effective interest rate, the entry will be borrowing cost account debit to financial liability. So the entry for interest recognition will be interest cost account debit to financial liability, and whatever payment you are going to make, the entry will be financial liability to bank or to equity share if it is variable number of share. If it is variable, because as we discussed, financial liability means when you can issue variable number of own share, element number 3 and 4. In element number 3 and 4, own equity share can be issued to settle a financial liability subject to the number of share issued are variable. Understood? So now some important point. What is the treatment of borrowing cost? The borrowing cost will be transferred to P&L account, but you should write a note here. Can be capitalized if conditions given under which standard? Ind AS 23 are satisfied. So borrowing cost can be capitalized if conditions given under Ind AS 23 are satisfied. But in this chapter, what we will do, if the problem does not mention anything about Ind AS 23, just transfer it to P&L account. Okay. How it will be presented in the balance sheet? As usual, by applying the current liability definition. Do you remember current liability definition? It is expected to be settled in normal operating cycle. It is a instrument which is traded within 12 months from the reporting date. Unconditional cash flow cannot be avoided. The payment cannot be avoided unconditionally. If this either of these four conditions are satisfied, current, otherwise non-current. But in this chapter they will not give you much detail. So what we will do, that portion of the liability which is payable within 12 months, if nothing is given, 12 month is the benchmark from reporting date for us. Okay, that we will put under current. Excess amount I will put it under non-current. I will tell you how to get it. Now the time has come to solve question number 5. On 1st January 20x1, James issued a loan note. What is loan note? Debt instrument. This is a question from Diploma IFRS exam UK. So there they use loan note, which in India we may call it debenture, debt. Okay, with of rupees 50,000 nominal value. But this question is equally relevant to you. Okay, equally relevant for your exam also. That is why I have kept it. It was issued at a discount of 50,000. So first of all, the face value is 50,000, but you have already given a discount of 16%. How much is that? 8,000. The cost of issue expense is 2,000. So what is your proceed minus all these expenses incurred? Net proceed 40,000. So this liability will be initially recognized at 40,000. Interest, this 2,000 and this discount has already got adjusted. I want to make one more clarification. In your intermediate or foundation course, you pass separate entry for issue expense. You credit or debit separately the discount account. Do you remember discount on issue of debenture account? All those items have gone. If 40,000 takes care of discount also, issue expense also. So only one entry will be passed for this everything. Bank debit 40 to financial liability 40. No need to debit discount account separately. That is under old GAAP, not under Ind AS. Is it right? Next is interest of 5% of the nominal values payable annually in arrear. Sir, what is annually in arrear means? At the end of the year. At the end of the year, every year. Bond must be redeemed on 1st January 2006, that is after 5 years, at a premium of 4611. So what is the redemption value? Redemption value is 50,000 plus 4611. So that is 454611. First you have to understand the question. And then your effective rate is 12% per annum. Now one good thing about these foreign exams is that they are less torturesome. If it was Indian exam, they would not have given the effective rate, and half of the country will not be able to calculate that only. So that means instead of testing his knowledge on accounting of financial instrument, we make him do the task of some other subject and he gets involved in that only. Let us see, if suppose this question comes in your exam and this line is not there, then you will have to compute it. How do you compute it? Year 0 cash flow will be 40,000. Year 1, 2, 3, 4, 5 cash flow will be, your coupon rate is how much? 5%. So year 1, 2, 3, 4, 5, the future cash flow will be 5% of 50,000, 2,500, and last year you have 2,500 plus 54,611. These are the cash flows. You have to find that discount rate at which present value of these cash flows is equal to 40,000. So that you today try as homework. It should come to around 12%. Is it right? You know how to compute IRR? No? Yes. In some other problem I will teach you. In this question we will not. We will take 12% as IRR. How do you proceed your answer? What is the question? How this will be reported in the financial statement of GEMS over the period to redemption? So how it will appear in P&L account, balance sheet, cash flow statement. So for that I need to first prepare two working notes. First working note will be initial recognition of financial liability. Initial recognition of financial liability will be proceed minus transaction cost. So my face value is 50,000, discount given 8,000, issue expenses 2,000. So my proceed after all these expenses is 40,000. So 40,000 will be initial liability. So if you are asked journal entry, it will be bank account debit to financial liability 40,000. Please do not write discount and issue expense separately. All of them have got merged in this. And then what we do in case of amortized cost liability, we prepare one amortization schedule. What it is called? Amortization schedule. Amortization schedule means how the liability account will move, proceed, or how the liability account would look like. So indirectly it is like a ledger of liability only. You have year 1 opening balance 40,000. On 40,000 we will calculate effective interest at 12%, 4800, and you will make the payment, so that we will reduce 2,500. So closing balance will be 42,300. Entry would be, I will just explain entry for these two items. Entry for this will be finance cost account debit, this 4800, to financial liability 4800. And the entry for this payment will be financial liability debit 2500 to cash or bank 2500. So automatically what happens? When I am crediting financial liability, I am adding it here. When I am debiting financial liability, I am deducting it here. So if you prepare balance sheet figure will be 42,300. At the end of year 1, the balance sheet will be 42,300, and then you just have to follow the same routine now. A very mechanical exercise. Opening balance 12%, 2500 payment is logged. Closing balance, bring it here. Opening balance 12% payment, and after 5 years you will find one amazing thing. This balance will become equal to 54,611. That is your cross check, and on the next day, next year 1st January, they will repay this liability. Understood? The question was how this will be presented. How this item will be presented? These items will be shown in P&L account. Every year in P&L account we will show finance cost, these figures, not the payment. That was old GAAP, 11-12 accounting, okay, where the actual interest paid to the lender was shown as interest cost. Here we don't do that. Here we recorded effective interest. Effectively how much you are paying, that is important, rather than contractual cash flow. Is it right? I have borrowed 50,000. I am making these payments. So I have to see effectively how much I am paying per annum, and that is called IRR. Otherwise in contract you may say in first 5 years no interest, directly after 5 years I will pay you 75,000. Does it mean you will not record any interest in the first 4 years? Let's say zero coupon bond, initial amount 40,000, After 5 years, you pay 60,000. So if I apply old gap, you won't recognize any interest in the first 4 years, and directly you recognize 20,000 in the 5th year. So that is wrong. So don't look at the payment pattern. You have to see what is effective cost you are incurring for using that money. So this brings substance over form in our accounting. What we have been doing for decades together was wrong, was actually wrong, because that was resulting into recognizing a wrong figure in P&L account, which is not based on effective cost you are incurring. These figures will go to cash flow statement, and these figures will appear in the balance sheet. That is the presentation. Is it right? In short. Then come to question number 6 also. Very important study material. And this question is very tricky in the sense that this will require you to compute IRR. This is our institute, okay? They will torture you with IRR calculation only. And I will tell you, lot of students have asked a query, how this institute has calculated IRR. In their study material, not a proper explanation was given. They simply said, for this question, IRR is 16%. How will a student understand? Okay, so we will solve it. If this question is asked as it is, you need to first compute IRR carefully. Without that, you will not be able to solve. So I will go to question number 6. A Limited has made a borrowing from RBC Bank, okay, for rupees 10,000 at a fixed interest of 12% per annum. Understandable. Loan processing fees was additionally paid for 500 rupees. So this I will deduct. As a borrower, I won't get 10,000. Proceed minus transaction cost. So I will have to pay 500 rupees. The complication is this. The loan is payable in 4 half-yearly installment of 2,500 rupees each. So first of all, the student get confused when it comes to half-yearly problem. Okay, annual he can handle, but it is half-yearly. So computation of IRR will become slightly complicated. Don't worry. Just like you do annual, you do half-yearly. What is the harm? Treat one period as 6 months. Loan amount 10,000, date of loan, date of repayment. Now this is again same thing. Repayment of loan start 30th September, paid half-yearly. Installment amount 2500, interest rate 12%. Some student make one more mistake. They treat this also as a effective interest rate. This is not effective interest rate. This is called coupon rate. This is called coupon rate or interest rate. And the effective interest rate will not be 12% because this was having some flotation cost. Had that flotation cost not been there, if this flotation cost was not there, 10,000 received, 10,000 paid, then your EIR and coupon rate will match. But in this question, there is a 500 rupees flotation cost on 10,000 rupees, which is a big sum. So therefore, your effective cost will be much more than 12%. And then to make your life more miserable, what they have done, interest will be charged quarterly. Principal amount you will pay half yearly, but interest you have to pay quarterly. Have you understood? So what is the number of year in this question? 2. So actually there are 8 payments involved, not 4. So the student makes second mistake. He takes 4 payments. There are actually 8 payments. Quarterly interest payment, half yearly principal payment. So tell me 10,000 rupees 12% into 3 by 12. So first quarter how much we pay? 300, na? Is it 300 for 3 months? Next quarter, these are quarter number 1, 2, 3, 4, 5, 6, 7, 8. You will pay 300 plus you will pay 2500 also. But then what happens? Your principal goes down to 7500 now. So in the third quarter, your interest will be on 7500 into 12% into 3 by 12. How much? 225. And in the fourth quarter, it is 225 plus 2500. Understood? Again, you paid 2500 here. So your principal becomes 5000 into 12% into 3 by 12, 150. Then 150 plus 2500, 75. 75 plus 2500. First, you have to identify the cash flows in the problem. These are my cash flows. And 9500 is my fair value at the beginning. So find out a discount rate which will equate the two. That discount rate will be quarterly IRR. Oh, the discount rate will be quarterly IRR because you are doing calculation where cash flows are every 3 months. Multiply by 4. Multiply by 4, that will give you annual IRR. Is it right? So this is a small complication which if you have not done before going to the exam, you will not be able to probably visualize that these are the adjustments to be done. So practice it before. So first thing you have to do, check whether it is a financial liability or not. Yes, there is a contractual obligation to pay cash periodically. Is there any own equity instrument to be issued? Is there any derivative involved? Nothing. So this is called, we have given a name to it, pure financial liability. Pure financial liability. That means there is no other element embedded in it. After some time we will see compound financial instrument which will have equity and debt embedded in it, both. So that is not pure, that is called compound financial instrument. Okay, later, that is for later. So I got this 9500. Then I have to compute the EIR. So what I'll do, I'll first make a chart of cash flows. I'll make a chart of cash flows. So this is, first you complete this chart by calculating these numbers. This we have discussed. And what is my initial outflow or initial amount? 9500. So you have to compute IRR by making guesswork. That is called trial and error method. More specifically, interpolation technique. Interpolation technique. So as I have told you, you are paying 12% interest. If I divide by 4, it is a 3% for a quarter. But your effective cost will be more than 3. Your effective cost will be more than 3. Why? Because we are also incurring the flotation cost. This 3 is only towards the coupon. This 3 is only towards the coupon part, the interest part. But what about that flotation cost which you incurred? Will that not increase your effective cost of borrowing? That will increase your effective cost of borrowing. So as a student, you can start with 4% here and compute the present value. It will come to 9562.73. Check it as a homework. And these two are not equal. Oh my God. So I have to take a higher rate now. I will take 5 or 6%. You can take in the exam. If this question comes, if you have doubt, take 3 to start with, take 5 or 6 to end with, no problem. You don't have to be exactly 4 and 5 because this is trial and error. My trial can be different from your trial. Closer these two rates, more accurate is your answer. If the two rates you are using for applying interpolation, if they are close, answer is more accurate. and at 5% you found it is 9152.78, then we will apply the formula of effective interest rate. Effective interest rate we are computing right now will give me quarterly effective interest rate, will give me quarterly. So how do I compute it? At 4%, my present value is 9562.73. So 4. Then I will take the difference between these two numbers and then I will take in the denominator difference between these two numbers. That is how the interpolation technique works. You must have done it. Okay, and multiply by difference between the two rates. Okay, multiply by the difference between the two rates. There is one more formula where we write like this: lower discount rate plus NPV we take. Effect is same. NPV means the difference between these two. That is what I have written here also. Yes or no? In your FM batch, they will teach you this formula: NPVL minus NPVH into H minus L. We are doing the same thing. The difference between the two NPVs is the difference between these two numbers only. No? That is also the same thing we are doing. So if you are used to this formula, please go ahead. You will get the same answer because you have written the same thing. Same thing in mathematics will give you same answer every time. So now how much you got? You got 4.15%. Now another mistake possible. A student take this as a final answer. This is not final answer. Annual will be 4 times 16.6%. Somebody has mailed me this query and said how this number institute has directly got in the answer. This is how they have computed, but probably they have not shown the detailed working for that. Okay. After that, what you will do? You have to see whether I can classify it as FVTPL instrument. I cannot. It is not a derivative. It is not a financial guarantee. It is not to prevent accounting mismatch, and it is not a contingent consideration. 4 items. Other than that, amortized cost. Make a schedule. But our payment frequency is 3 months. Our payment frequency is 3 months. So I will use finance cost at 4.15%. Same IRR but divided by 4 again. So it is 4.15%. Just check the calculation for me. Check whether the interest 4.15% is correctly calculated or not. So in your institute answer, they have not made this table properly, but I have done it for you. Just check. They have also done it, but their style is different. Please check the entire table. Is it right now? And then now the next task is, the question was, how would the loan be accounted in the books? How will the loan be accounted in the books? The meaning of this question is, you have to prepare a ledger, or some authors they pass journal entry also. Okay. So it is very simple. Same table now you have to present it here. But because it is quarterly payment, I will not close my book every quarter. So I will first pass 4 entries that will complete 1 year, close the year, again pass 4 more entries in the next year. Understood? So it will be something like this. First day when you took the loan, 1420x1 by bank 9500. Then I will record by interest on 30th June. From the above table, which figure you will record? 389 or 300? always that finance cost figure. Payment made is to be written as a payment towards the liability to bank 300. 30th September by interest 401 to bank 2800. Again 31st December by interest 301 to bank 225. 31st March 297 to bank 2725. Payment will be as per the above cash flow table. To balance carried down 4838. So you will close after 12 months. Done. Next year by balance brought down 4838 by interest 200, debit side to bank 150 by interest 204 to bank 2650 by interest 102 to bank 75. Last 31st March by interest 102 and to bank 2575. In the last year, what we should do, always remember in this chapter and next chapter, this payment amount is fixed. So this will be balancing figure. Even in your table, I have written balancing figure. The reason is, it's the last payment. Payment amount is fixed. So the interest will become the balancing figure. So this is how amortized cost instrument problem will be solved. Very easy. Now come to your paragraph number 14 again. Reasons for variable number of share. If the liability will be settled by issue of variable number of share, it is a financial liability. A contract settled by issuing variable number of share. Why do number of shares vary? Because in element number 3 and 4, what was element number 3? Remember, contract, non-derivative, settled in own share, variable number of share will be issued. And what was element number 4? Derivative contract, settled in own equity instrument other than fixed cash for fixed number of share. So own shares are used for settlement. When own shares are used for settlement, and if the number of shares are varying, number of share to be issued can vary, we will call it as a financial liability. The reason for number of share to vary is sometimes it is linked to market value of the share. I will pay 10 lakh rupees to you in my own share, but it will be issued at market price on the date of settlement. So number of share can vary. Sometimes in a single contract, various interdependent events are specified. Various interdependent events are specified, and due to which the number of shares can change. So they may say, if this happens, 10 share will be issued. If this happens, 15 share will be issued. If this happens, 20 shares will be issued. So a contract which issues different number of share for different events, then it has a variability, and therefore it is a financial liability. Then it is a financial liability. Okay. If the index goes to 17,000, Nifty index, we will pay you 10 share. If the index is 17,100, I will pay you 15 shares. So the number of shares to be issued are varying. This kind of contracts are called financial liability. Such contract qualify variable test, hence it is a financial liability. Exception. Exception means following cases number of shares can vary, but still it is not treated as variable. Example, suppose we have entered into a contract whereby number of share will be issued if bonus is declared. If bonus will be declared, then the person to whom we have promised, he will also get a bonus share. Like it happens in convertible debenture. If you have issued convertible debenture, at the time of issue of convertible debenture, you say we will issue you 10,000 share on maturity. He was happy. The debenture holder was happy. I will get 10,000 share. But before it got converted, you have issued bonus share to your other shareholders. Don't you think this fellow will also ask bonus share? Because he had an assumption that I will get 10,000 share. So my stake in the company will be 10,000 divided by 20,000. I'll become a 50% owner. But before you could issue share to him, you have issued bonus share to other shareholders. So he is going to object. It is called protective right. If the number of shares can vary due to protective right given to the holder, it is not treated as variable. It is not treated as variable. Like this example, a debenture holder will also get bonus share if bonus shares are issued to equity shareholder. So his share can vary, but it is protective right. Then stock split. In stock split also, what is stock split? Share of higher face value is broken into shares of lower face value. Is it right? One share of rupees 10 is converted into two shares of rupees 5. That is called share split. Now there are some contracts outstanding where the number of share have to be issued 10,000. But before that those 10,000 share could be issued, the company has gone for stock split. Don't you think the holder of those 10,000 share or the rights to get those 10,000 share, now he will demand 20,000 share. But that is for protective right. That is only the protective right. It is still an equity instrument. It is still an equity instrument, assuming that the conditions are satisfied. Reverse consolidation. 2 share of 5 converted into 1 share of 10. So what will happen? All those contracts where the number of shares have to be issued, they will also automatically get converted into 1 share for every 2 existing share. So that is all for protective right. Sometime company may make follow-on offer at a lower price, right issue at a lower price. These are called protective rights. Or sometime the number of share can be issued only because of the passage of time. If 3 years are over, so many share will be issued. If 4 years are over, so many shares will be issued. There is no contingency involved here. Time will pass. Passing of time is never a contingent event. Am I right? Time will keep passing. So therefore, if it is protective, ignore this, and still the treatment will be equity, assuming the condition of equity are satisfied. When variation is specified in discrete contract for discrete event, that is separate contract exists for separate event, these may be called independent events affecting variable number of share. If this event happen, share gets listed, 500 share will be issued. If profit will be 2000 crore, 2000 share will be issued. So this will be called variable. Okay. If variation is specified in discrete contract for discrete event, separate contract exists for separate event, this can be called independent contract affecting variable number of share. No question on this. Enjoy. These are some theoretical points. It is there as a part of the standard, but not for the student basically. It's more for the practitioners. Once you qualify, then every time you have to see whether this contract has financial liability angle or not. Now special points. Zero coupon bond Have you ever heard zero coupon bond? Yes. What happens here? Only two cash flows are involved. Today and on maturity. There is no other cash flow. Usually they have a long life like 3 years, 5 years, sometimes 10 years also. They don't pay coupon periodically. They don't pay coupon periodically, but they are issued at a heavy discount. That is why they are also called deep discount bond. Longer the maturity, longer will be the discount. So face value is 10,000 on maturity, but issued today for 7,200 rupees. And you will get after 5 years 10,000 rupees. So what the student will have to do here, now this is not FVTPL instrument. For FVTPL, it has to be derivative. It is not a derivative. It has to be a financial guarantee or a loan contract. It is not that also. It should be a contingent consideration. It's not that also. Or it should be for accounting mismatch, assuming it is not for that also. So it has to be amortized cost. So what you will do in this case, you will have to compute effective interest rate. How do you compute effective interest rate? By applying IRR formula, or by you can apply this formula, maturity value divided by your net proceed. Mathematically we are doing the same thing, to the power 1 by n minus 1, to the power 1 by n minus 1. What is 1 by n? This is just a formula of future value only. So in case if it is not given in the exam, suppose you don't remember this formula, then future value is equal to present value into 1 plus r to the power n. Future value divided by present value is 1 plus r to the power n. So 1 plus r will be future value divided by present value to the power 1 by n. And if I remove this 1 on the left side, it will become minus 1 on this side. So direct formula. I am telling you because they may not give you the IRR. And if they don't give you the IRR, this way you will have to find out and then follow the same principle which you did in the previous two problems. Only this time on the debit side you will not have payment entry. The payment entry will be only in the last year. Remaining accounting will remain the same. So to save time, this is the direct formula of EIR of ZCB or DDB. Direct formula. Otherwise, any other method, if you know, you are free to apply. Another complicated instrument is preference share. The life has changed after Ind AS was introduced in India for the preference share. What was the home of preference share under old GAAP? Equity. It was a part of share capital, means equity. But now one has to see the features of preference share and accordingly decide: 1. It is a pure financial liability. 2. Pure equity. And 3. Hybrid, means compound financial instrument. So preference share can be in India now either equity or liability or a compound financial instrument, depending upon what kind of features are loaded in that preference shares. So don't jump to any conclusion unless you read the features of that preference share, how the dividend will be paid, how the principal will be redeemed. Okay, and that will affect your classification. So it can be elementary or pure, or it can be pure equity instrument, pure financial instrument, or it can be Have you read perpetual bond paragraph? This perpetual bond paragraph has not come. Just a minute. Why we have not discussed? Has it not been prepared? Let me check. Otherwise, I will read it from your book only. This is zero coupon bond. Maybe I have missed out that paragraph. So don't worry, I'll explain that first. Okay. So next, first we'll discuss this part B, perpetual bond or non-redeemable bond. Possible or not? Possible. What is perpetual bond? There is no redemption clause, no redemption date specified. No redemption date means it can be redeemed or it may not be redeemed. Whenever it will be redeemed, it may be after a long period of time. I don't know redemption date as of now, which means these bonds only pay coupon. They only pay coupon periodically. If you don't pay anything, why will somebody invest? There are companies which have issued perpetual bond. There are banks which are now issuing perpetual bonds. Is it right? And if you trust it, you invest it, every year they will just keep on paying you the coupon. And what about the principal? The principal part is not redeemed. So these bonds usually are like hybrid instrument. They are like, because as far as this part is concerned, you have an obligation to pay, contractual obligation to pay cash. As far as this part is concerned, there is no contractual obligation to pay the principal part. So therefore, it is like a compound instrument, because some part you have collected, but there is no contractual obligation to redeem that part. That is called perpetual bond. Principal will continue for infinite period. They should be treated as CFI, usually CFI. Sir, what is CFI? Compound financial instrument, means hybrid. Hybrid means it has attributes of equity also and debt also. It has attributes of equity and debt also. Why financial liability is there? Financial liability is there because interest obligation is there. So write one formula there. Financial liability will be equal to coupon divided by market rate of interest. Coupon divided by market rate of interest. Coupon divided by market rate of interest. And what about equity? The equity portion will be equal to net proceed minus financial liability. Proceed minus financial liability. You also write here, this I have written in simple term, but there is some complication involved. Refer para on compound financial instrument. Refer para on compound financial instrument. So if it is a compound financial instrument, the formula would be, first point, financial liability. The difference between the amount received and the amount attributed to financial liability is the equity component. So suppose you raised, face value is 100 and market rate is, let us say, 12%, but the coupon rate is 10%. Coupon rate is 10%. So how do you get this part? This part you have 10 rupees will be your annual coupon, divide by market rate 12%. 10 by 12% is how much? 83.33. This will be treated as a financial liability because what you are paying back, what you are redeeming, interest, has a fair value of 83.33. This formula is in FR or FM. You have studied A upon R formula for an infinite annuity. A upon R. Annuity divided by discount rate. And then remaining amount in our example we can attribute to equity. Remaining amount we can attribute to equity. Understood? Financial liability is arising due to interest obligation. Market rate of interest is identified for calculation of financial liability, like I did this, and then split accounting is applied. This is called split accounting. 100 rupees has been split between the liability and equity. So when such instrument will be issued, bank account debit will be 100, to financial liability will be 83.33, and to equity will be whatever balancing figure, 16.67. This we will discuss in detail in this section called compound financial instrument. Can we go to the next paragraph? Preference share. Yes, preference share can be either pure liability, pure equity, or CFI. Now I have made a small summary for you. Original standard has lot of paragraphs which you will get tired of reading, but the summary and substance of that is this. And now you can on your own learn to identify what is the nature of financial instrument. So usually you have two things in financial shares. Preference share. One is your preference dividend and one is the principal. And I will tell you something simple. If there is a obligation to pay both, which cannot be avoided, then what is that? Liability, pure financial liability. If you can avoid one of them, but not the other one, what is this? Compound instrument. If you can avoid both of them, equity. Simple. Now applying that logic, you can answer any question now on preference share. If preference shares are redeemable, financial liability, because you can't avoid it. If preference shares are fully irredeemable, no obligation to pay anything, zero obligation to pay anything, then it is pure financial, pure equity instrument. Then your question is, so this is about, let's say, principal amount. The principal amount is redeemable, principal amount is irredeemable. So accordingly, liability and equity. What about dividend now? Preference shares are entitled to mandatory fixed dividend. So here we have both mandatory clause. Here principal plus dividend, both are mandatorily to be given. Both are to be mandatorily given, not avoided. Financial liability. Now this is important because the student can confuse this. Preference shares are entitled to cumulative fixed dividend. Cumulative preference share. Preference shares are entitled to cumulative preference share. So tell me whether cumulative preference dividend is liability or equity. So you will think that it is cumulative. See how your 11, 12 foundation inter teacher have taught you. And today I am going to tell you something different. They said if dividend is not paid in 1 year, it will be paid in the second year. Correct? But my question is, what if it is not paid in second year, third year, not third year, fourth year? Can the company stretch it for a very long time? Yes. There is no company can avoid it by not paying it. Let it accumulate. Let it accumulate till the company will go into liquidation. Then that time we will see. Is it right? So therefore, you can avoid it. You can avoid it by not paying the dividend. It will accumulate, but you can keep on avoiding it for a very long time. Is it right? So this part is equity instrument. So the cumulative preference dividend is equity because it can be avoided for a long time. And what about non-cumulative? This in any case is equity. If you don't, there is no obligation to pay only. And if you don't pay, it lapses. Then preference shares are entitled to dividend linked with ordinary share. What this clause says in some companies, but in India I have not come across any company issuing this kind of preference share. Preference dividend will be paid only when equity dividend will be declared. The terms and conditions says preference dividend will be paid only in those years where equity dividend will also be paid. Is it liability or equity? This part, this dividend part, it is equity because company can infinitely not pay equity dividend. It is at the discretion and therefore it can be avoided. Okay. Next, preference shares are convertible into fixed number of equity share. The principal part is my liability, but it will be converted into fixed number of share. So it's a non-derivative instrument convertible into fixed number of share. Element number 3. Element number 3 of liability says non-derivative contract which will be settled by fixed number of own equity share is an equity instrument. But the same thing, if I make it variable, it will become a financial liability. And if preference shares is redeemable and dividend is non-cumulative, now what will you do? Preference share is redeemable. So principal portion is liability and dividend portion is equity. Oh my God. So this is compound financial instrument. This is compound finance. Okay, one more thing I wanted to ask you, hence I have not written. Principal is redeemable. Dividend is cumulative. What is the nature of this preference share? You have to look at the two separately. I have given you the hint. Principal is redeemable, which cannot be avoided. This is a financial liability. Dividend is a cumulative. Now here I have given you the hint. If it is a cumulative dividend, it is equity instrument. This part is equity. This part is equity. So what is the nature of the instrument? Compound financial instrument. Okay, I will test you one more. Have you noted this down? For your understanding, if you understood, it's okay. Principal is redeemable, dividend is cumulative. Compound financial instrument. Compound financial instrument. A student will say it is a pure financial liability, but no. Cumulative preference dividend means you have rights to avoid it. So any cash flow which you have right to avoid it, then it is not liability. Should I try one more? This combination and this combination. Principal amount is convertible into variable number of share and dividend is cumulative. This is financial liability. This is equity. The answer is written. When the same instrument have both the feature, compound instrument. Okay, I'll change it. Cumulative fixed dividend, fixed number of equity share to be issued on conversion. This is equity, this is equity. Now the whole instrument will be called equity instrument. Okay. Okay, I'll make one more combo for you. This is how in our office we make combo nowadays for financial or reporting, SFM, audit, law. Every day, half a day is spent on this only, this and this combo. Instead of teaching now, our energy has been utilized in more productive work. These two combo. Mandatory fixed dividend and convertible into fixed number of equity share. So one part is financial liability, one part is equity. So this is compound financial instrument. So look at the two parts separately. Okay. If both parts are financial liability, then the whole instrument is pure financial liability. Both parts are equity, like this example, earlier example, it is equity. One part is liability, one is equity, compound instrument. Now next paragraph is buyout obligation. This is usually not asked in the exam, but what is a concept here? The concept is that a company may enter into a contract with shareholders that you invest in our company. You will say, why I will invest in your company? What if I don't find a good price after 1 year? You say, don't worry. We will buy out your stake at a certain amount. At a certain amount. That is called buyout obligation. So contract entered into today to purchase your own share at a future date. So how to do accounting? Now this is like a derivative instrument now, because it will be settled at a future date in own share. In own share. Sometimes company enter into a contract wherein company is under contractual obligation to buy its own share, but the question is its own share at a fixed price. That will be purchased at a later date. Fixed for fixed condition is satisfied. So this is equity. Okay. These contracts are derivative in nature, but this will be treated as a derivative equity contract. Hello. Derivative equity, not derivative financial liability. Not derivative financial liability. These are equity instruments. And of course, if it was variable, then financial liability. How do I do accounting? But Ind AS 32 requires that. So what is your contract here? You will issue a fixed number of share against a fixed amount. Against a fixed amount. You will buy back a fixed number of share. And second is you will pay a fixed amount. It's a buyback at a future date. It is simply put buyback at a future date. And because of the fixed and fixed nature, it is an equity contract. But then at the same time, you have an obligation here. Can you see this? You have an obligation to pay a fixed amount of cash to buy back those shares. So standard says bring that also in the books of account. Bring that liability also in the books of account, because you have an obligation to pay cash at a future date. And this will be charged from equity and either paid at expiry of the contract or retransferred to equity. So the meaning of this line is that I will create a financial liability today by passing an entry equity account debit to financial liability, and this will be at present value. This will be at present value because financial liability is measured at fair value. So if there is a gap between today and the date of payment more than 12 months, it will be discounted. Okay. every year you will provide interest cost on that. On maturity, it will become equal to the amount you have committed to pay with interest, because you have taken present value. With interest, it will become equal to amount payable on maturity. Understood? Now the other party, suppose he approaches you and asks for money, then you will pass the entry financial liability to bank. But suppose that fellow does not approach you only, then you retransfer the balance in financial liability to equity. Then you retransfer the balance in financial liability to equity, because the other party may not come and demand share or may not offer you the share back. By the time the market price would have gone up, why to use my option and sell at a fixed amount? If it is an option, he may not turn back to you. In an option, the other party will look at his scenario first. Am I going to get by buying, giving it for buyback, or am I going to sell in the market and get more money? So if he comes back, financial liability to bank. If he doesn't turn up, transfer it back to equity. Transfer it back to equity. On this point, I have a question for you. This question is not very important. A Limited entered into a contract with B Limited on 1st April 2021, which provides B Limited a right to put back 10,000 shares back to A Limited at rupees 35 per share. So this is a contract to buy back own share. After 3 years, can you see the gap? After 3 years, the other party can put the share back to you for 35 rupees per share. So 10,000 into 35, 3,50,000. But because it's a put option, the party is going to pay you premium. The party is going to pay you the premium. But this is a derivative contract which will be treated as equity contract. Derivative equity. Why? Why? Fixed number of share 10,000. Number of share fixed 10,000. Amount is fixed 3,50,000. Is it right? So this instrument will be called as a derivative equity instrument, not liability. So the premium received will also be transferred to equity account. Premium will also be treated as a equity item. Then on maturity date, I have taken both possibility. B may exercise the option, B may not exercise the option. What entry will you pass? And discount rate is 10%. What was the purpose of giving the discount rate? This 3,50,000 is payable after 3 years. So I need to record the financial liability by discounting it. Then every year I will add the borrowing cost in that. Every year I will add the borrowing cost on that. It will become 3,50,000 again after 3 years. If the party wants to exercise his option, we will buy back the share, we will pay him the cash. So financial liability to bank. If he doesn't exercise his option would lapse, balance in financial liability will be transferred to equity again. So journal entry. First you received the premium. Bank account debit to derivative equity account. Bank to derivative equity. Read note number 2 below. Why derivative equity? Premium on option received is treated as equity because it is a contract to pay fixed amount against fixed number of own equity shares. This standard also asks you to also account for the financial liability. You have an obligation to pay 3,50,000. which cannot be avoided. Which cannot be avoided. So since it can't be avoided, if the counterparty wants to exercise his option, you will record it as a liability today by debiting SOCI equity account. So in SOCI, you may have say retained earning account or general reserve account, debit that, credit financial liability at present value. Read note 1 below. Financial liability is created because entity cannot unconditionally avoid payment. Then every year for next 3 years, what we'll do, we'll take the opening balance multiplied by 10% and record it as a borrowing cost. Borrowing cost will be transferred to P&L account. Again next year, your opening balance will be increasing every year because we are adding the interest to that balance. So next year interest will be total of these two into 10%. So that is 28926. 28926. 28926. Next year what you do? Next year interest will be balancing figure. Why? This is the last year. Total I have to pay 3,50,000 minus I have already recorded in my books these three numbers. So this year I will record interest as a balancing figure. It will save, it will ensure that my balance becomes 3,50,000. After that, case 1, the party comes, he says, I want to sell this share back to you for 35 rupees. He wants to exercise his option. So I have already created a liability for that purpose, financial liability to bank. And if suppose he does not exercise the option, if he does not exercise the option, so whatever financial liability is lying in my book is my gain because I don't have to pay anything. So that will be closed by transferring it to equity, 3,50,000. So this is not very important, just you have to go through it once. Okay. Next is, why this person is crying? Let us see. Buyout contracts for non-controlling interest. Again, for your information, not very important. Just 1 or 2 paragraphs are mentioned in your study material also. Never in your exam they have touched this point. So one day before the exam, just you can, if you don't have time, skip it. Why this person is crying? That was my query. He is a non-controlling interest. He is holding some shares in subsidiary and he feels he has got stuck. So what the parent company does, he says, don't cry. We will acquire your shares. If you think you have got stuck, don't worry. We will acquire your stake. Is it right? So many times, if you want to bring stakeholders in a company, you have to give them some kind of exit route. What is exit route? Buyback route. Because otherwise he may think that I got stuck. This company may not perform and my money or investment will get locked. Like in the earlier example, buyout obligation, where you are giving commitment in your own share. Now here the parent company is giving commitment to acquire the shares in subsidiary company to an NCI. Understood? Parent is telling this NCI, don't cry. I will buy out your stake in the subsidiary. So if any parent enters into a contract with NCI for its buyout, then following entry is required. Now, entry would be, again like the previous para D, NCI debit to financial liability because I have promised to pay him some amount. So NCI debit to financial liability every year, like the previous problem, borrowing cost account debit to financial liability. And on a maturity date, two possibilities are there. NCI wants to sell his share back to the parent company. So parent company will pay him the amount, financial liability to bank. NCI does not want to sell his share. Market price would have gone up. Company would have started performing well. So he thinks that let me keep the share with me only. So I will reverse the entry. Financial liability to NCI. Next is derivative on non-financial asset acquired by the entity. Derivative on non-financial asset acquired by the entity. If an entity has acquired any non-financial asset and it has got a derivative also on it, and it has also got a derivative also on it, then in that case there are actually two contracts. There are actually two contracts. One, NFA, non-financial asset. Let's say you have purchased a machine and you have also got some put option on that. So machine will be accounted like machine under Ind AS 16. No change in the accounting of that machine. And plus you have a put option also on that. That put option will be accounted like a derivative. The put option will be accounted like a derivative. Both will be treated separately. Non-financial asset will be accounted as per respective standard. I gave you the example of a machine. You bought a machine and you have a put option also. You can sell it after 3 years for a certain amount. Okay. So in that case, put option is a derivative contract. Account it like a derivative. Check whether it is an asset or a liability. Derivative can be asset or a liability. Again, I don't find many questions on that. Now there is a carve out coming. What is carve out? A major difference between IFRS and Ind AS. So you will see Indian creativity now. Foreign currency convertible bond. Tick mark important for a 4-mark theory question. Okay. Have you heard FCCB? Indian companies have issued outside India bonds. And these bonds have two features. They are issued in foreign currency. Of course, reason number one, they want to raise foreign currency for their foreign currency requirements. Second is, in order to make the instrument attractive, they have given a conversion option to the holder. So what that holder thinks, the company does well, share price will go up, I'll convert into share. And if the company does not do well, in any case, I will get a fixed cash amount. So I have the option to either go for cash or go for share. So that is the reason they invest in FCCB. Now the question is, what will be the classification of this? What will be the classification for this? Will it be called equity or will it be called liability? Now, as far as interest part is concerned, that is liability. We are not talking about that part. We are talking about the conversion part. It will be converted into a fixed number of equity share. Suppose the bond is issued for $10,000. So I said, I will not give you $10,000 back. Against this fixed $10,000, I will issue you 500 shares of the company. So what is Indian view? Indian view is $10,000 is fixed, 500 shares are fixed, fixed for fixed, equity, fixed for fixed, equity. What IFRS is saying, this is $10,000, but you have to convert into rupees. To convert into functional currency, then check. If you convert into functional currency, every day it will change. So IFRS is viewing that after you convert into your functional currency, this amount is variable because as the exchange rate will change, the number of the amount is changing. Both are not fixed. If both are not fixed, I will not call it as equity. So there is a difference here. So FCCB, which are convertible into fixed number of share, are treated as equity by our standard. Okay, but IFRS treats it as a liability because the foreign exchange rate changes. So the amount once converted into functional currency is a variable cash flow. Why Indians have done it like this? Because in India, if I show the whole instrument as a liability, my debt equity ratio, you can imagine what will happen to debt equity ratio. If suppose it is 1:1 right now, if I only show the convertible portion as a liability, some company might hit the debt equity ratio of 2:1, 3:1, 4:1. And with such high debt equity ratio, further borrowing will become difficult. Financial risk will increase in the eyes of investor because he will compute debt equity ratio. He will say 1:1 became 3:1. Oh my God. Is it right? So all your leverage ratio, which you learn in financial ratio chapter, all those ratios will go for a toss. Okay? And that is why we have brought this change in the standard, because Indian companies need foreign money. And if we make them show this as a liability, they may be rejected by some of the investors because of the high debt equity ratio, because of the lower current ratio. Because of this, current ratio can also get affected. Okay, so therefore they have made this carve out. Got the answer? There is some reason for everything. Okay, the institute has given some different reason altogether. They have said, institute says we believe that it is a fixed amount only. IFRS is wrong. Read, you will understand in your institute material it is written. We believe we are right. Okay, it is a fixed $10,000. How does it matter? But IFRS says it matters because exchange rate is fluctuating daily. So there is no right or wrong answer. If you are solving Ind AS problem, this is like equity. This is equity. If you are solving IFRS problem, this is liability. Next point, important point, H tick mark, because on this we are going to solve few questions after some time. Settlement alternative. Settlement alternative means a financial instrument can give you two settlement alternative, like optionally convertible debenture. Optionally convertible debenture gives the holder two options. Either he can go for cash or he can go for equity. The classification will depend on who has the option. Who has the option, plus it depends on whether the option is in the money or out of the money. In the money means beneficial and out of money means not beneficial. Technical term used in SFM also. In the money means you are having in a benefit, you are in a beneficial position, and out of money not a beneficial position. First of all, when you read the problem where you have settlement alternative, if the option is with the holder, he can ask cash, and as an entity I have no alternative but to settle it in cash. I cannot avoid cash. Can I avoid cash? If I have issued optionally convertible debenture, holder is having the option, I don't know what he will ask, but I know that he can ask cash also, and if he asks cash, I cannot avoid. The standard says that portion will be treated as a liability. What he will exercise later is a different matter. Today, on the inception date, I will call it as a liability. If the option is with the issuer, then one has to see whether the option is in the money or out of money, whether it is beneficial to issue equity instrument or no. So if it is beneficial, they will issue equity instrument. If it is not beneficial, then they will be issuing cash. So if it is in the money to issue the share, equity instrument. If it is out of money, it is a financial liability. Now the next issue is, institute question is silent many times. Tomorrow also when we will solve one question, today also, tomorrow also, they don't mention only who has got the option. So what you will assume always, to keep it simple, it is the holder who has the option. It is the holder who has got the option. So if it is holder who has got the option, it will be treated as the redemption of the principal part will be treated as financial liability. Okay. And if it is the company issuing the instrument has an option, check what the company is going to do. Because if the things are in my hand, I can decide. If things are in your hand, I cannot decide. So then you have to read the problem and see what the company will decide. Example. Is the example printed? Yes. ASF Limited issued 9% debenture which can be redeemed or converted into fixed number of own share. The classification will depend upon whether the option is with the holder or the option is with the entity. If the option is with the entity, you have to see whether it is in the money, out of money, and what the ASF wants to do. What ASF wants to do. What about share warrants? Share warrants will be treated as a derivative equity instrument. They will be treated as a derivative equity instrument. Why derivative? Settled at a future date. Less investment is involved. You have to pay a very small amount and your company will issue a warrant to you, which after a certain time you can convert into a fixed number of equity share. So they are derivative equity instrument. Then we have also talked about para 16A to 16D. Para 16A and to 16D talks about deemed equity. Deemed equity means they appear as a financial liability. They have contractual obligation, company has contractual obligation to pay cash, etc. But because they have got some specific special feature, the standard says, wait, call them deemed equity. And what are those features? I will discuss next page in para 16A to 16D of the standard, not our book, of the standard. There are special paragraph A and A to D, and if those conditions are fulfilled, even though the instrument may look like financial liability, they will be treated as equity, and therefore the accounting as an equity instrument will be done. Now next point is, what is financial asset? This standard is simple and small. The next chapter is lengthy. Now we'll discuss financial asset. One good news, this standard does not go into details of financial asset, because if it is a financial asset, it will come on the asset side. In case of liability side, there is a problem. It can be a financial liability or it can be equity. So the presentation issue is more on the liability part, less on the asset side. So therefore this standard does not go into details of asset side. But of course this will be a major part in the next standard 109, which we will take probably tomorrow once I finish it. So financial asset has 6 component, 6 element. Financial liability had how many element? Financial liability had 4 element. Financial asset has 6 element. And I will tell you a trick to remember. financial liability has 4 elements. Trick means logically, not just mug up, and it has 6 elements. It has 2 elements more. Which 2 elements more? First and second. A financial asset means cash. There is no similar item in the liability definition. A financial asset is an equity instrument of another entity. There is no parallel in liability. But the remaining 4 item has exactly counterpart in the definition of financial liability also. See, third point is contractual right to receive cash or other financial asset. What was mentioned in element number 1 of liability? Contractual obligation to pay cash or another financial asset. Obligation to pay has become right to receive. Obligation to pay has become right to receive. Easy to remember. And there we had written point number 2, if you remember element number 2, a contract on settlement will become a contract which has become unfavorable. A contract requires exchange of one financial asset or financial liability with another financial asset or liability under potentially unfavorable condition. I have only changed one word here, favorable. Contracts which will require exchange of financial asset or financial liability under favorable conditions. So here comes derivative. The same example which I had given at that time, one party has written a call option at 50, market price has become 60. It will become financial liability for the call writer, but immediately it will become a financial asset for the call option holder because he can buy a share for 50 whose market price is 60. Is it right? In derivative contracts, if derivatives turn in your favor, it becomes a financial asset for you and it becomes a financial liability for other party. All of you have studied derivative is a zero-sum game. Derivative is a zero-sum game. One party gains, one party loses, the loss is equal to gain. Hence zero-sum game, but there is a winner and there is a loser. So winner will call it financial asset, the loser will call it financial liability. That is how you will interpret derivative. Next is, what is the third point? Fourth we have discussed. Fifth point is contract that will be settled in own share are non-derivative in nature and the entity will obtain variable number of share. Reverse of element number 3. Non-derivative contract settled in own equity and the entity will receive variable number of shares. Example, investment in own convertible debenture of rupees 10,000. Example of this element number 5, a company has invested in own convertible debenture of rupees 10,000 and suppose the number of share is variable. The contract is designed in such a manner that the number of share is variable. I'll explain again. Some companies issue convertible debenture and the terms of the convertible debenture may require company will issue variable number of its share. Possible? Yes. The shareholder or the person who has invested, he may bargain with you. Why I will get a fixed number of share? I should get a number of share based on market price at that time. What you did, you bought that convertible debenture back from the market and now you are holding it. Now you are holding it. So therefore these are investment in own debenture and convertible into a variable number of own share. So therefore this meets the definition of financial asset. Okay, this will be treated as a financial asset because it will be converted into own variable number of share. At the same time, if I change the question and I say I am holding my own convertible instrument, but it will be converted into a fixed number of share, then it becomes a equity instrument. And once it becomes an equity instrument, it is not an asset. Very important, it is not an asset now. It is an equity instrument and it will be shown as a deduction from equity. It will be shown as a deduction from equity because it is a equity instrument, but it is a negative equity. It's on the asset side. It's on the opposite side. So I will show it as a negative item on the equity side. Never ever they have asked question on this. They should ask. Okay. So far they have not asked. Past is not guarantee of future. Then element number 6. This is reverse of element number 4 of financial liability. Contract that will be settled in own share, that are derivative in nature and which will be settled other than fixed cash for fixed number of share. Other than fixed cash for fixed number of shares. Same thing they have mentioned. Then it will become a financial asset. Then it will become a financial asset. It will be settled in future, but not fixed amount of cash and fixed number of share. Rather, either of the 3 possibilities should be there. Cash is fixed, number is variable. Cash is variable, number is fixed, or both are variable. Then such contracts will be treated as financial asset. What if it satisfies fixed for fixed test? Equity. It will be equity. If any of the above conditions are met, then it is a financial asset. If contractual right is subject to government approval, so sometimes there may be some formalities involved, then also it is a financial asset. Like normally when you invest in some government bonds, etc., which may have some government approval pending. At inception, we do not see whether it will be realized or not. We have to just see, do we have the contractual right to receive cash or not? If the answer is yes, it is a financial asset. And if there is an uncertainty about collection, the standard will also tell you provide impairment loss, but that is in the next topic. The moment there is uncertainty about its recoverability, then you can recognize the impairment loss. How to compute impairment loss on financial asset? Next chapter will tell you. Settlement alternative. If it is contingent on certain condition, sometime the payment will be made subject to certain condition. Payment will be made subject to certain condition. Amount will be paid if the EPS of the company is 20 rupees per share. In that case, we will assume that the condition would be satisfied. But here one thing we have not written in the book. If the contingency is not genuine, then we don't recognize it. What is the meaning of contingency? If not genuine, then do not recognize liability. Then do not recognize financial liability. So contingencies, we will pay you 1 lakh rupees if Raga becomes Prime Minister in next election with 425 seats in Lok Sabha. My God, whether he will get 42.5 or not also we are not sure. And you put a condition that I'll pay you 1 lakh if Raga becomes PM with 425 seats in Lok Sabha don't recognize financial liability. This contingency is fake, is not real, is not genuine. But EPS can be 20 rupees. So one has to also check that. Other settlement alternative we have seen, once we have issued an instrument check, do we have contractual right which can be enforced? If the answer is yes, then it is a financial asset. Now the next part we'll discuss today, and this will complete the major theory part, and after that only two important issues will remain: compound financial instrument and early redemption of compound financial instrument. Two important topics on which you get questions in the exam. Just 1 second. Battery is running low. What do I do? Just call some staff. It is not plugged properly. Anyway, just let us finish this part. Meaning of equity. I'll finish it for today, this part. Any contract that evidences residual interest in the asset of the entity after deducting all of the liability is called equity. Power charge नहीं हो रहा. What is equity? Equity is the residual interest in the net asset of the enterprise. Equity is the residual interest in the net asset of the enterprise. What does that mean? After paying all liabilities, whatever remains will belong to the equity. And if you are holding such instrument, you are an equity holder, equity instrument holder. And if you are holding an equity instrument, that instrument is a financial asset for you, and equity for the other party. Is it right? So one has to see whether the holder of the instrument has a residual interest in the net asset of the enterprise. Falling instruments are equity instrument. Falling instruments or component of an instrument are equity instrument. For example, ordinary shares. Remember, the standard does not use the word equity share. It uses the term ordinary share. Ordinary shares means no preference at all. No preference at all. No preference at the time of dividend. No preference on repayment of capital. That is why they are called ordinary share. So equity share is the example of ordinary share. Then those instrument or components which pass fixed test, like the definition we have seen, if a contract has fixed amount of cash against fixed number of share, those contracts are also equity contracts. Those contracts are also equity contract. Those contract which pass fixed for fixed test, fixed number of share against fixed amount of cash, or at least fixed number of share will be issued against those instrument, those are fixed to fixed test passed. Those are also equity. And then the standard says there are some instrument which are like financial instrument, financial liability, sorry, but we will call them as deemed equity. Para 16A to 16D. If an instrument qualifies any element of financial liability as well as qualifies deemed equity condition, now there is a problem, because it has got fixed, it has got financial liability element also, it has got equity element also. The standard says we are the umpire. It is treated as deemed equity. Matter closed. Is it right? So what are deemed equity? Paragraph number 4. Tick mark, but not very important. Very theoretical paragraph. I'll quickly read it. Don't take much tension about it. So right here, do not take tension, because they don't, so far they have not touched upon this area. If an instrument has to be a deemed equity instrument, it has to satisfy 7 conditions. How many? 7. They are called paragraph 16A to 16D, which I have simplified it for you. Original text is a little more complicated. First is, the instrument is a putable instrument. Putable instrument means, what is putable? You can give it back to the company and company has to pay you the cash. You can give it back to the company and company has to give you the cash. A simple example is unit of a mutual fund. A unit of a mutual fund is a putable instrument. Any time you can give it back to the mutual fund and the mutual fund is bound to pay you the cash. So that is an example. Unit of certain mutual fund. An instrument is a putable instrument, or any instrument which obligates to deliver pro rata share of net asset. Underline. That means any instrument under which the holder will get pro rata share in the net asset. When do you get pro rata share in the net asset? When you are like an owner. When you are like an owner. So if you are going to get a pro rata share in the net asset on liquidation, and see, all sentences are connected by and. Why I have written and in capital letter? To remind you, all conditions are necessary to be classified as deemed equity. Then such instruments are most subordinated instrument on liquidation. Most subordinate means they will be last in the queue. After paying all other creditor, lenders, then they are paid. Okay, they cannot demand payment before others. And such instruments are entitled to share in the net asset only. They are entitled to share in net asset pro rata, and there should not be any limit on that. There should not be any limit on that. If the agreement says you will get share in the net asset on liquidation, subject to a maximum of 5 lakh rupees, then it is not a deemed equity. If the company has a net asset of 1000 crore and you have 2% stake, you will get 2% of 1000 crore. You can't put limit on this. But the moment you see a limit that on liquidation subject to not more than something, it is not a deemed equity, matter closed. And the instrument should have identical feature. All the instruments should have identical feature in terms of their rate or maturity or convertibility or whatever. Okay, then instruments have no other rights like right to convert or any other special redemption right. They should not hold any special right like conversion right, etc. Total cash outflow on such instrument should be based on the profit and loss of the entity. Just bring before your eyes mutual fund unit and you will find it fits into all of this. Yes or no? How much the mutual fund unit holder earns? It depends on the profit or loss earned by the mutual fund. They don't pay you a fixed amount. They pay you as much as they earn and they distribute it among the unit holders. And all the units are alike. All units have no special redemption right or anything. Nothing special is given, and entity should not have a contract which is not at arm's length with such instrument holder. So I suppose invested 10 lakh rupees in a company, and then I say I don't want interest, I don't want any liquidity, but you should make all your purchases from me. Okay, all conditions are satisfied, but then I have put one condition in the agreement: I will invest money in your company. You should purchase from me. So that means indirectly you are compensating me by making purchases. So if there is any other hidden agenda behind this instrument, hidden agenda means somewhere you are passing on benefit to the instrument holder in some other way, then it is not a deemed equity. If all conditions are satisfied, it is a deemed equity. Now we will continue tomorrow. Thank you very much. Have a good day. Bye bye.